What is stock market and how it works? Stock markets are where individual and institutional investors come together to buy and sell shares in a public venue. Nowadays these exchanges exist as electronic marketplaces. Share prices are set by supply and demand in the market as buyers and sellers place orders. What is the easy definition of stock market? It is a place where shares of public listed companies are traded. A stock exchange facilitates stockbrokers to trade company stocks and other securities. A stock may be bought or sold only if it is listed on an exchange. Thus, it is the meeting place of the stock buyers and sellers. Let's learn about how the stock market works. The concept behind how the stock market works is pretty simple. The stock market lets buyers and sellers negotiate prices and make trades. The stock market works through a network of exchanges. You may have heard of the New York Stock Exchange or the Nasdaq. Companies list shares of their stock on an exchange through a process called an initial public offering, or IPO. Investors purchase those shares, which allow the company to raise money to grow its business. Investors can then buy and sell these stocks among themselves, and the exchange tracks the supply and demand of each listed stock. That supply and demand help determine the price for each security, or the levels at which stock market participants, investors and traders, are willing to buy or sell. Buyers offer a bid, or the highest amount they're willing to pay, which is usually lower than the amount sellers ask for in exchange. This difference is called the bid-ask spread. For a trade to occur, a buyer needs to increase his price or a seller needs to decrease hers. This all may sound complicated, but computer algorithms generally do most of price-setting calculations. When buying stock, you'll see the bid, ask, and bid-ask spread on your broker's website, but in many cases, the difference will be pennies and won't be of much concern for beginner and long-term investors. Let's see how you can get money from stocks. When you buy a share of a stock, you automatically own a percentage of the firm and an ownership stake of its assets. If you paid $100 for a share of stock and the stock appreciates in value by, say, 10% during the period you own it, you've earned $10 on your stock investment. So you might think to yourself how you might lose money in stocks. Investors who experience a crash can lose money if they sell their positions instead of waiting it out for a rise. Those who have purchased stock on margin may be forced to liquidate at a loss due to margin calls.